Welcome to the Estate of Reality podcast, where we talk about the real world of real estate. Join in and listen to two of the smartest people in real estate as they talk about the real reality of real estate. It's nothing like reality TV. This is the real world. If you are planning to buy, sell, or invest in real estate, or if you are a real estate agent, this podcast is for you. Your hosts are Melissa Haley, broker for the North Texas Top Team and CEO of Agent Advantage Coaching and Training, as well as Stephen Etzel, real estate broker, instructor, and owner of Stephen Etzel Real Estate Consulting. Join them as they talk about all things real estate and subscribe today to catch all of the episodes.
Well, welcome everybody. I am Melissa Haley, CEO of Agent Advantage Coaching and Training and broker for North Texas Top Team. And we're here today with the Estate of Reality with Stephen. How you doing today, Stephen?
Absolutely wonderful.
Tell everybody a little bit about you.
I'm Steve Etzel, broker owner of Independent Realty and also a trainer for Etzel Training and Education.
Awesome. And we got a special guest today. Aren't you excited?
I'm fired up.
Fired up.
He's got the same haircut. Where'd you go wrong?
I know. Our special guest today is Ian Jones, Integrity Mortgage Corporation. And yeah, you guys have a little bit in common there, like same hairdo, looking good, looking good. Ian, thanks for joining us. Tell everybody a little bit about you before we get started.
Yeah, so I'm a lender here in DFW. Of course, we do loans all over Texas, but predominantly in the Dallas-Fort Worth Metroplex. I love doing loans. I got into loans because my first home buying experience sucked, and I wanted to make sure that no one else's did. So here we are.
I love that. You got to make the world a better place, one loan at a time, sir. One loan at a time. Love it. All right.
I've heard that not only with loans, but also real estate, which is kind of ironic. It should be a flow.
Is that how you got into real estate?
Yeah. That's not how I got in personally, but I've heard it a few times. Let's put it that way.
Yeah, I love it.
It's amazing what it'll happen to you'll do when you get scorned on something as major as a real estate transaction.
Yeah.
Better too at what you do.
Yeah. Well, and some people think because they had a bad experience and they think, well, if that's all they did, I can go do that. I mean, anybody can go do that. Right. Yeah. And then you get in there and you're like, actually, I could do this so much better.
Which is good because it keeps us working because we're trainers. But that doesn't making them upset, making a bad experience. And look what we got. It's a rotation. Wonderful.
Well, so today, we have Ian here from Integrity Mortgage. We're going to chat about some home buying things, right? Like if you're planning to buy a house, unless you have a lot of money laying around, you're probably going to get a mortgage. So can we just start off chatting about how about first-time home buyers? First-time home buyers, they have no idea what they're doing. They're like, I wake up one day and they're like, I'm really tired of being in this place. Maybe it's an apartment or maybe they're living at home or with family or something. And they decide, let's do this. Let's buy a house. What are some things that they need to know, Ian, and where do they need to start? And can we chat just for a moment about first timers so they know what to do?
Yeah. I mean, on the first time home buying front, first thing you need to do is, general people are going to reach out to a realtor first. Let's be honest. They bypass the lending immediately and they go straight to a realtor, right?
They want to see houses. That's what they think they need first.
They need a tour guide.
Exactly.
A tour guide.
Yeah, they want a tour guide. And what they need is to get pre-approved, right? And a first-time home buyer, when they call me and I talk to them, they always say, hey, I'm a first-time home buyer. What are the programs, right? That's the question is, what are the programs? So first thing I ask is, well, are you a veteran? And they're like, oh, no, not a veteran. Okay. Well, there are two great programs. You have your conventional side of things and you have your FHA side of things. And they're like, well, what's the difference? Well, FHA is a government loan. And then of course your conventional goes straight to Fannie Freddie, or not owned by the banks, but serviced by the banks. And it's a conventional loan. It means there's no, what's what I'm looking for?
Government.
Yeah, no government involvement within the loan aside from it being owned by Fannie or Freddie, right? So when I'm talking about these programs, I always say, well, you have a 3% down option and you have a 3.5% down option. One's going to be your government, one's going to be your conventional. And they're like, oh, you can do 3% down? I'm like, yeah, that's your first time home buyers on the conventional side. Because most people think FHA immediately for first time home buyers.
Right.
Because I think they've established that F as being first time, right? And then HA being something else. So in their heads, that's the loan that makes sense. And I'm always like, well, based on your profile, I can show you all of the options, but I think you'll find that on your end of things that a 3% down conventional is going to look much better for you. And then of course, down at a more granular level, you do have the rates, right? So on a conventional first time home buyer doing 3%, there's Home Ready and Home Possible. And those are with Fannie and Freddie. And those are awesome programs for people who, may not be making $200,000 a year because it's based on certain cities and counties where they can get a better rate for themselves initially if they're at those thresholds of what are the AMI or the area median incomes. And we've seen a lot of great success for first-time home buyers with that, even in a more rate-conscious time, whether it be now or later on down the road.
Yeah, rates are not as amazing today as they were during the pandemic.
And then, the biggest thing, what's that?
I was just going to ask a question, but go ahead. I want to finish out. See.
Yeah, and then you have when the big banks get in trouble, they have to start getting money out faster and cheaper. So a big bank got themselves in, and then they created the community lending program. And what that means is there are certain pockets in certain areas that they have mapped out that were underserved by them during certain times. And the government said, hey, you got to get more loans in these areas. And a lot of people get to benefit from that because it's not income dependent. It is solely area dependent. So when people were putting out, much higher rates, we were getting back things from the community lending program that were much lower. And this is obviously at we're correspondent lenders, but brokers can do the same thing too. And we were getting insanely great rates back just based on locations and had no income requirements, none of those things. It was strictly area dependent. So there's a lot of things first-time home buyers can do.
Yeah, location, even in lending.
Yeah, that's what I was just going to ask when we say the location programs. So that's awesome.
Yeah. What was your other question though? Was that it, Stephen?
Yeah, I was just going to branch off what he was talking about with different areas that also made a difference too of the lending practices.
Yeah.
I mean, as long as banks continue to get themselves in trouble, there's a way for the general population to be able to benefit from it.
Yeah. Well, and when you say get themselves in trouble, it just means that they need to put dollars back into the communities that they serve, right? Not like get into trouble like they're going out of business.
No, absolutely not.
Just making sure. There's, crazy stuff going on in the world. Okay, well, so, we got this location-based stuff for the community reinvestment. We've got location-based stuff like the USDA out in the rural areas, right? Which is also location-based. We talked a little bit about, okay, so people are now sort of at least aware that there's FHA versus conventional, and there's different kinds of lenders that can do different stuff. So one of the things that we were chatting about earlier was, we got these first-time home buyers that are buying their first house, and they go through this process, and now they've lived here for a little while, and maybe they want to do a step up. They want to move from that starter home to buy maybe a bigger home, or maybe they want to, change their location or whatever. But this time they're going from that first-time starter home to they're moving up. Are there some things going on there that maybe people need to just know about or be aware of before they decide to make that move?
Well, I mean, it's one of two things, right? And Melissa, you run into this, and Stephen, I guarantee you run into this too. People want to get out there and buy that second step up home, but not understand what it actually looks like. So it can be, one, you're going to roll yourself contingent with the sale of your previous home. Mm-hmm. Or two, you're going to get yourself pre-approved to be able to hold both mortgages. And either direction that you go on your step up buy, as far as I'd say your offer end of things, like the offer that you're making to the house you're trying to pick up, The contingent part is the hard part with having to sell your previous house. But if you can go in there and you're pre-approved with both mortgages and you got cash to be able to buy the next one, I mean, that's a sweet spot, because then you can turn that other previous house into, I don't know, a rental.
Well, then you got number 3 problem. They want more than they can get. That's the one. Yeah. I was waiting on that one right there. You get pre-approved for 300, they all want 900. So
yeah,
you always run into that too. So there's always a situation. There's always a challenge. But yeah, but we can work through it.
So I like your idea of rental, though. We just did a podcast recently with somebody regarding property management and rentals. So we learned some things that might have discouraged people from being a landlord. But is there the possibility that maybe this is a good idea to keep your first house and to be a landlord and to buy the next house? What does that do to my lending opportunity? Because I have all this extra debt. I have hundreds of thousands of debt, and I'm going to get hundreds of thousands of more debt. Is this going to mess me up on my DTI, my debt to income ratio? Or is it good because there's going to be money coming in every month because you're only counting my monthly debt? Like, how does that work?
So if you are you asking specific to if you have rentals already?
No, you said if I was a first-time home buyer, I could keep my house and turn it into a rental and buy a bigger one.
Yeah. So
if that was me, how does that work?
Yeah. So it's pretty cut and dry, honestly. If you hire a great team like the North Texas Top Team, they'll be able to get your house leased before you close on your new house. So as long as your previous house is leased, we don't have to count that against you as far as your debt to income ratios. So if you have a lease for 12 months on that property with Mary Jane down the street and she's paying $1,800 a month and your current mortgage is $1,200 on that pre-existing property, you're good to go. It's null and void on your DTI.
Yeah. Okay.
It crosses itself out.
Yeah. Okay.
Has to be for a year though. That's the key.
Why?
It's got to be a year. So if you're going the short-term rental, just like to caveat off of what Stephen's saying, like you can't say, oh, we're going to use it as an Airbnb. We can't exclude that from your DTI. That will not work because the variances involved in all of that, and that you don't have experience in that world, things of that nature. But yeah, no, Stephen's correct. I mean, you have to have one full year. And for Fannie or Freddie, I don't remember exactly whom, one of them does require to have your deposit in your bank account before they will allow you to not have that against their DTI, the previous mortgage payment.
That makes it kind of hard though if you want to sell a house to buy a house, because that means you would have to be renting for at least a year. Does that make sense?
Do you have to rent for a year, or you have to have a year
lease in place for a year before I can put that under the contingency?
Actually, no. It can be a brand new lease. So let's just use my scenario.
For a year, brand new lease. Okay.
Yeah. So Melissa is going to be renting my current house. This one, very nice behind me.
It looks really nice back there. There you go.
Beauty right there.
Yeah. She's going to rent this house, and I'm buying this house behind Melissa right now.
I think you should buy Stephen's house.
And then I buy Stephen's house. As long as my current property has a lease agreement that is 12 months in length on it, and it starts on December 15th, and I'm closing on December 16th, it's all good in the hood. It does not get counted against you DTI side. It doesn't have to have a pre-existing 12 months behind it or a tax return behind it. We just need to show that there is a tenant committed to 12 months there.
So I want to make sure I'm clear, because you said one of them, Freddie or Fannie, might require me to have a security deposit. So let's just say you're selling that beautiful house, or you're not selling that, you're keeping that beautiful house behind you and you're buying something else, and you're ready to buy the other one, but you're going to be closing, in the future, in a month, 45 days, 60 days, whatever, on your new place. So you find me, I'm a nice little tenant. You're getting me all approved to move in, and I need to go ahead and pay my security deposit in order to get the property locked in for me. So now you've received the security deposit weeks before I'm moving in. And then I've already signed the lease and I'm supposed to move in on this date. And so when you're purchasing the property, you're just like, hey, I'm going to buy it, but I'm not going to buy it until this date. So when my lease starts, do I just not get to move in the first day?
I mean, I guess it really just depends on when the closings happen. Generally, yeah.
Just wonder, or maybe you're going on a staycation. You and the fam are going to go stay at a hotel for 3 days while you're doing your closing, and I'm going to get to move into my rental house, right? Maybe that's it.
Yeah, generally they'll have the contract begin after it's usually like 7 days after they've closed on the new property, had a chance to move out for their new tenant.
Okay.
I was just for sake of example talking about that, but yes, taking at face value, that sounds awkward.
I was like, man, I don't even get to move into that beautiful rental.
Hence the commence date, right? So you can always post date it 7 days, I think it is.
Yeah, there you go.
Is that one of those legal things, Stephen?
Yeah.
Tell me what it is. What's it called?
There's no name for it. That's just hence the commence date, right? So basically, I don't know. There's your legal. Sorry, I don't have nothing for it on that one. But that's how come it doesn't have start dates on your leases. So that makes sense to me, at least.
All right. Well, there you go. I don't have to move in that day.
Yeah, there you go.
There you go.
But I'm sure they're going to have a time frame. I think it's 7 to 14 days or something like that. 7 to 14 days, something like that. You have to have it within that period of time. Because I know the deed of trust says something on it. If you have a deed of trust, you got to move into the house, or else they get a little upset with you. What is it, 60 days?
Yeah, it's 60 days.
So, there are some time frames that they're going to probably go off of when you need to be aware.
Yeah, we were having some issues.
That's why I let North Texas Top Team handle the details. And all I've got to do is do alone.
There you go, right there.
There you go. Well, we were having, I mean, Stephen, you probably too a little bit. We were having some issues when it was that very crazy time right after the pandemic, when everybody was just like going crazy and they wanted to buy right now. And they were letting people stay in the house after they bought it. And some of them for, 90 days. And then the lenders were like, no. So the 60 days, I mean, that it is important to know that lenders have certain timelines that if you buy the house, you got to move in because that's your primary residence. And that's what we loaned you the money to do, was to live there. We didn't loan you the money to do something else weird with the house. You're supposed to be living there.
Yeah. Cut back on fraud and everything else. Another thing too is, a lot of times they don't like that temporary lease to be very long too.
Mm-mm.
Correct. Yeah. I mean, I've had ones where people were like, hey, yeah, we're under contract, but they want a 90-day lease back. And I'm like, so you guys are landlords now?
Yeah.
Right.
You're buying this as an investment? No, it's our primary. I'm like, we literally cannot, because of guidelines, do this. Plus, your insurance that you're pulling out on that property is for you to live there, not for Stephen to live there.
Right.
So you need to be occupying it. We have had insurance companies do pop buys, believe it or not, to make sure that the people are actually living in the residence if there was a really long lease back.
Makes sense.
And one of them got popped on it. They hadn't moved in yet, but turns out they had demolished the inside and were redoing the entire thing. So insurance was like, hey, cool, no problems. Yeah, you guys live there, but you're not there right now because you can't be. You're in a hotel.
Yeah, they probably made it vacant. That's what they did. But on the flip side of it, you got to look at it and say you also got to change your insurance policies too. That's another thing that it should be proactive on when you start doing these temporary leases. But that still doesn't justify the fact of why you're just in it for 90 days, in it for a lease. but all that's going to do is protect you if something happens. Other than that, good luck.
Oh,
exactly.
Yeah. Well, so, all right. So we've chatted about like the first time buyer. We've kind of chatted about some ways for the first time buyer to then become the move up buyer and what that might look like. When I'm buying on the move up buyer, and I know that maybe now I've got that renter in there, maybe that's the deal. Is it still 3% down?
3% down is for anyone who has not owned a home in the last 3 years. That is what's considered a first-time home buyer. So,
that's a good tip right there. Wait, back up. Say it again. What's a first-time home buyer?
A first-time home buyer is anyone who has not owned a property within the last 3 years.
Not my first house, just my first house in a while.
Your first house in a while, correct. So you could have sold your current house right now and lived in a rental for 3 years, and by the time you come out of that rental, well, she's a first-time home buyer again.
Wow.
That's awesome. Yeah, I had somebody call me from Chicago and said, I own a property in Chicago. If I buy it in Texas, am I a first-time home buyer?
In Texas.
I said, well, you still live in America? You're still moving to America, man. All right, so that's state by state, right? So yeah, that's it. That's it.
Still, but then let me backtrack. So 3% is really a first-time home buyer thing. So if I do that, and even if I turn it into a rental and I'm no longer a first-time home buyer, or maybe I don't turn it into a rental and I just sell and I take the proceeds and buy my next house or whatever, how much money do I have to have down on a not first-time home buyer thing?
Stephen and I both know it is 5% is the minimum that you can get away with.
And
even
I don't know. The people listening
unless you do an FHA loan, you qualify for FHA, you can have more than one FHA too.
Correct. Yeah, you could go that route. I mean, it really just depends on what it all looks like.
And if you're a veteran, you're partially still entitled, possibly. So you never know. There's a lot of different options out there.
Yeah, just make sure it's really far away from that previous VA loan.
Yeah. And it better be for a really good reason too.
Yeah. It's mostly for what is it, when they move them around to different bases and stuff, that bonus entitlement that you can, in fact, let's touch on this because this is really funny. It came up the other day. So there's a couple that's moving in from, I think it's Florida to Texas, and he's a veteran himself, and he didn't want me to pull his COE, which is fine. I just kind of gave him the site, sent him on his way to get it done, and then his wife calls me. She calls me like 20 minutes later. She's like, Ian, we got his entitlement. We only have $36,000. There's no way we can buy a house. And I was like, 36 grand. Wow, you guys have the entire entitlement. You can buy anything you want within conventional loan limits. And she's like, what? I'm like, okay. There are still veterans out there that don't know that 36,000 means you can pretty much buy anything you want to buy with 0% down. The only time you get into down payment territory is when you're trying to go VA jumbo and buy the extra insurance attached to it, or the extra, I forget the exact name for it. But yeah, 36,000 is the full amount to buy anything you want to buy at 0% down.
I think that's pretty impressive information, because I think a lot of people think you can only own one house, VA, that's it. Can't do anything else. You guys are both shaking your head. The people listening can't see you shaking your head, but y'all are saying, no, that's not true.
You can definitely have more than one VA loan out, as long as your distances work out from the previous residences, right? I mean, you're pretty much going to be delegated to the East Coast, Mid Coast, West Coast. So I would say, and Stephen, stop me when I'm wrong, 3 houses is probably your max you'll ever get away with on a VA because of distances.
Yeah.
And at that point, yeah.
You need to run out sooner or later. Yeah.
Yeah. I mean, it really it's a distance thing with the VA. It's got to be, I believe it's a minimum of like 100 miles or something like that from the previous residence. And you've got to have a ironclad reasoning with as to why you're wanting another one. And it also will cost you, right? It's not like it's another 0% down loan, right? So if your entitlement is at 0, you can have bonus entitlement because now you're 100 miles away buying another primary, but you still have to put down money and you have to fund the additional over the top of it. So if, let's say, your remaining entitlement calculates out to $400,000 and the house you're buying is $440,000, you can do that loan, but you're going to have to put down, I believe it is 5% of the amount over the entitlement amount, which in this case is $400,000. So I think you'd be putting it against the 5% against the $40,000. So you would put that down as a down payment for the extra entitlement to work.
Yeah.
But I don't see a lot of veterans with $1 million of these loans. I mean, Stephen, have you? Yeah.
I mean, I get a lot of it also with veterans and Texas Veterans Land Board. You can buy a veteran home and a Texas Veterans Land Board. You can buy both. as long as you do it the right way. There's a lot of opportunity that I think a lot of people don't know.
Exactly. Yeah, totally. 100%. Especially in the VA world, there's a lot of benefits that the veteran has no idea about that we only know because we've done the loan, and it's trial and error on our end sometimes, right? You don't always have the right answer, but then you get the one deal that gives you the right answer.
Yeah.
Hey, you learn as you go. It's like you never run out of your entitlement either, which is really interesting too. I've had people that were like, "Hey, we're in Vietnam." I was like, "All right, you got to be entitlement. Let's take a look at it." You know what I mean? Awesome. You just don't run out. It's awesome. It's a good plan.
Well, and I think that our veterans deserve so much more than just their housing, right? They have all these benefits, but I'm pretty sure that when you first go in as a veteran to talk to someone about your benefits, I think the book is like 22 inches thick. Like it's this humongous book. You get all of these things, you get all these benefits, and this is just one of them. But man, it's a good one. But I think it's probably overwhelming to the veteran, and that's probably why they're like, I had no idea I could do these things, because it's just so overwhelming.
Their defense, have you ever tried to read that?
It's like,
I'll just tell you right now, if you ever try to read that, be like, I have no idea. So, it is very confusing.
Yeah. My response is, I don't know the answer to that, so I'm going to call the VA real quick.
right, exactly.
And then they'll be more confused when you ask them, wait a minute, we're looking through this book. We don't even know what we're reading. Yeah, it's pretty funny. But, the more you know, the better off you are. And unfortunately, I wish we could tell more people they have opportunity. It's like I tell people all the time, everybody should buy a house, and VA is a perfect opportunity. FHA is a perfect opportunity that people aren't taking advantage of. It's like I say to people all the time, FHA, that's why one day say, well, only people with poor credit and no income get FHA. That's incorrect. FHA is kind of the subprime of the government. We totally understand that because it's higher debt to income ratio, lower down, a little rougher credit. But the bottom line is that's where a lot of people are at. So it's not necessarily because you're low income. It's because a lot of times you can't save money. I know people that make $500,000 a year got what, $10,000 in the bank. How does that happen? Then you look at all these people that are, their debt is 55% in debt, and they make a fortune, but they just can't manage it correctly. But can you still buy a house? The answer is yes. So there's other possibilities for everybody, and that's what's so great about this business.
Yeah. I mean, talking about FHA specifically, right? I mean, I've had borrowers that are 780 credit score, but they just got out of 3 years ago a chapter bankruptcy, right? Conventional is not going to hold them.
No.
So they're going to go the FHA route because FHA has more forgiving on those things, right? Yeah. So instead of waiting to purchase a house to buy it conventionally, they bought it FHA. We're talking 780s, guys, but had a chapter bankruptcy, right?
Yeah.
So then once the 5 years hit, we refied them conventional because that's what they wanted to get rid of their MI, and bam. But that worked out one time. Okay. That is not an every time thing. Stephen, back me up on this. That was luck that all these people got in like this and then refinanced to the twos. I mean, crazy. And with no MI.
Yeah.
Happen probably going forward. But sounds good. Yeah. But you know what? Those are the stories that everybody needs to hear, that it can happen at least. And it did happen, I mean, I talk to a lot of renters, and you ask them, why don't they buy? They don't know.
They don't know they can. They think they can't. And I feel that when I talk to people and they're renting and we say, well, have you considered buying? They're like, oh, my credit's terrible. And I'm like, when was the last time you looked? And they're like, well, I mean, I got a Credit Karma. And I'm like, all right, well, first of all, probably not the right number. And second of all, you really need to have somebody look at it with you. Like,
I'm going to run some numbers from somebody that knows credit. Yeah.
Yeah. Or they'll tell me my credit's terrible. It's 700.
Oh, that's horrible.
I'm like, oh man, you should totally talk to a lender.
Yeah.
Melissa, do you know why Credit Karma is wrong?
No, I have no idea.
So Credit Karma runs its scores off of Vantage, right? And Stephen and I look at FICO, period.
Yeah.
So when you see your Vantage scores, it has nothing to do with what your FICO scores look like. We can see a swing between them of like maybe 40 points up or 40 points down on FICO.
Easy.
So that's why Credit Karma is your FICO score and not your FICO score that lenders look at. And that's something that a lot of people, they get crossed. They're like, oh, my Credit Karma says I'm at like 680. I'm like, wow, we have a pretty good shot of being in the 700s on our FICO. They're like, what? I'm like, yeah, let's take a look. I'm always right.
Yeah.
Wow. Okay. Well, there you go. So people just don't know. And their credit score is going to impact their, first of all, ability to get a loan, but also their interest rate, right? And interest rates have been, kind of going all over the place lately. But I have a question about interest rates a little bit, because we've been talking about these VA loans, and everybody kind of knew that VA loans were assumable, but aren't other kinds of loans assumable? And if the rates are high right now, is that a potential tactic that if I'm a home buyer, I mean, Stephen, would you tell somebody to do that if they were buying a house, that they ought to maybe look at seeing if they could assume someone else's mortgage at a lower, better rate?
All day. Oh yeah, I would assume somebody's mortgage. Absolutely, I would. In fact, especially if they had equity. All right, so if you assume somebody's loan to get their equity, that's number one. Number two, you get their payment, but you're helping them get out of the loan. But what can I do with it once I assume it? I might be able to refinance it too.
Yeah. Yeah, but I want to buy it.
What am I going to use it for? If I'm going to use it for an investment property, that might be something. But if I'm going to use it for a primary residence, it's got to live it for 6 or 7 months or whatever it is. Once the interest rates go down, boom, refinance it. You got a better interest rate and you got a bunch of equity in it.
Yeah.
So loan assumptions are not bad, and VAs are assumable by non-veterans as well, and FHA are assumable. So you look at it and go, opportunity, and I think that with the economy changing the way it is, we might be looking at those like we did back in 2005, 2006, 2007. That might be a possibility as well.
Well, that's kind of what I was thinking, because I think that there's some faction of people out there that were maybe consider selling their house, but then they're like, you know what, I don't know, man, if I sell, I got this great like 3% rate, and when I go and I want to upsize, I want to get a bigger house, so my house payment's already going up, and man, the interest rates are like, well, 7% or some other random number that's higher than what they're at now. And they're like, I don't know, that's like a double whammy. More principal that I got to pay towards, so my payment's going up. More interest, that means my payment's going up. And I just think I should just stay here. I'm not going to sell. But could they sell and maybe buy an assumable mortgage? Maybe. Do they have an assumable mortgage? Is that a selling point for them when they go to sell their house? I don't know. I just think there's some discussion that could be had around it for sure. So I don't know. What do you think, Stephen? What do you think, Ian?
I mean, I have only heard the legend of someone actually assuming a mortgage, to be totally honest with you.
Legend.
Yeah, I mean, I have people all the time that call me up and like, I'm just going to get this. I'm going to assume this one. We don't need you anymore, Ian. We got this thing. They're like, it's FHA, blah, blah, blah. I'm like, okay, great. Well, hey, have fun. Get that mortgage assumed. Do the whole 9. Well, I mean, you still got to go through all the ticker tape of assuming a mortgage, right? It ain't just a, hey, U.S. Bank, you have this loan. I'm taking it over. Send me the paperwork, right? So you still have to qualify, right?
Right.
And you still have to follow all of the same exact terms that terms and things that we have to do in the lending world, right? But it's at the bank level. So 1, it's not quick. 2, it's going to be arduous. And 3, and Stephen, you may have, Melissa, you may have, but I've never heard of anyone actually pulling this off.
It's like a ghost.
Oh. Whoa, this is a mystery. I used to live down in San Antonio, down by the Air Force base down there. The military base. They used to do it. We used to do a lot of VA ones.
Yeah, but
FHA, that might be a little different. I've only heard the mystery myself of somebody doing one.
Yeah,
VA is a lot easier to do because you're basically swapping letters out if it's the same veteran, veteran for veteran kind of thing. So military bases work out a lot differently than the FHA actually do. But yeah, you're right. It's not as easy as one thinks it is.
And
if you watch an infomercial, it's real easy.
Oh yeah, everything's simplified when they're paying for a time slot, right?
Yeah, I mean, the last infomercial I watched, you just assume a loan, you got $85,000 in equity and flip it. I mean, what's wrong with people? It's simple. Yeah. You buy an apartment complex with $1 million of equity, flip it. What's wrong with you people?
Oh my gosh.
So let me run back to the VA assumable here real quick, because we talked about the FHA part. So something I found out the other day, and people probably know this, but I don't know if everybody knows this, if you assume a veteran's loan is just a standard civilian, so Ian taking over a veteran's loan, that veteran does not get their entitlement back. And we were just discussing about how we should do more for our veterans, take care of our veterans. And, you know, guys, veteran to veteran, one thing. That's cool. Assume on a veteran's loan as a veteran. But if you are an average Joe Schmo, come on, buy that place. Don't assume their loan and tie up their entitlement. That's super uncool to me.
I think maybe the general person listening might not know, or watching might not really understand what entitlement is. Can you give us the infomercial version so that it's quick and easy of what does that mean when you say entitlement about a VA, about a veteran, that they are entitled to this benefit? Will you chat about it?
Yeah, so every veteran that comes out of the military after X amount of service, I forget what it is offhand. I had a VA guy at the Veteran of Affairs yell at me about it because this guy had like just missed it by like 45 days or something like that to have a COE. But basically, your certificate of eligibility is the amount of money that the government is willing to lend you for purchasing a home. And it is a $36,000, looks like a very small amount on paper, but it goes through a bunch of, you know, multipliers and things like that based on current markets, which is great because they don't have to continue to rewrite everything about VA every year, because what they do instead is, you know, raise the loan limit, and that in turn gets the veteran more. But it's the veteran's ability to purchase a home with 0% down. So if you tie up their eligibility or the $36,000 that they're entitled to, then they can't go and buy another property at 0% down. I mean, they very well could, but as we were talking about earlier, generally you're going to have to pay on, you know, and they got to be really far away, right? If they were staying in the same city that they allowed you to assume their loan within, they're not buying another house in Plano if they've had somebody assume their loan in Plano. They'd have to be gone. So now that veteran doesn't get to use their entitlement in the city that they live in, or even hell, the county that they live in, honestly. I mean, if you think about distances. So it's just their money that they're given by the government to purchase houses for putting their life on the line, or watching nukes, or maintaining Hummers, you know, doing anything that they did in the service. They're entitled to be able to use that loan and that money, and that's the program for them.
Yeah, the zero down part.
Yep.
Yeah. Yeah, because they can still buy a house. They just can't get what they're entitled to, which is zero down.
Correct.
Right. I love that. Well, so do you think, and I'll just ask both of you, because Stephen, you do, you know, all the things, right? You do the mortgages, you do the broker stuff, you do all the things. Is anybody saying, I don't want to sell though, because I don't want to have to buy another house with another higher interest rate? I mean, is that out there on the street? Because I haven't heard it, but people keep telling me that that's why nobody's going to move this summer. I don't know. I don't think I believe them.
I'm not going to lie. I've heard it twice, 2 or 3 times, but I can talk them out of it pretty quick.
Okay.
You know, it depends on how much equity they have. Let's put it that way. You know, and it's like I told them before, you know, you look at it and go, yeah, you got a great interest rate at 2.5%, but you spent $300,000 over value.
Yeah.
If you're going to spend market value at 6.5%, what makes sense? You know, we have loan programs out there, you know, 1, 2, 3 buy downs, whatever, you know, whatever the situation is, we can get you into where, you know, hopefully in the next 6 months to a year, we can refinance you at that point too. So I think some of them they watch the news. Let's put it that way. You know, that's almost as bad as watching, you know, asking Google questions or looking on Zillow. That's almost as bad, I'm telling you, because they freak people out and they don't really understand what's going on in the real world. They got to ask professionals what's really going on out here. And I think once you talk logically to them and they understand, I think you can talk them off the edge. And I've talked to people off the edge before, like, oh, that does make sense, you know. But I haven't really heard it per se. Oh my gosh, I'm freaking out because I don't want to move because I got to buy that. I haven't got to that point yet.
Okay. I don't know. Have you heard anything like that, Ian, or not so much?
Yeah, I mean, I've heard a fair bit of that. In fact, I had a friend, well, I don't even know. They're not really my friend, just somebody who saw more of my content and messaged me on Facebook. They're like, hey, we want to buy this house down the street from our house. Right now, we're living in 1,800 square feet. We want to get up to 2,800. We're about to have our third kid. I'm like, this sounds important. You should probably buy another house. And like, but interest rates are so high right now. And I'm like, granted, that could be a thing. But what is a low interest rate? Oh, 2%. Okay, well, we'll never see that again. Yeah. So let's get that out of our heads. That's historically low. That's something that's never going to happen again. You can tell your grandkids about it. It'll be a fun story, but it's not happening again. So interest rates are what they are, and they're always going to be that way, right? In that date and time. I remember my first time, this is a story I always tell people, when my first house, I paid $170,000 for it. My payment was like $1,250 a month. Okay. Then I decide I need a bigger house because I've got kids, right? They need space, so they're not in mine. So I found this house in Plano that I'm in right now. This is definitely not a house in Plano. And it was $300,000. And that's the most I'd ever thought about paying for a house. I was like, my God, that's double. And I got that payment. And as soon as I saw it, I was like, my God, that's a crazy payment. Wow. $2,500 a month is crazy. 2016 Ian. And now I'm like, oh, now I live in this house and I only pay $2,500 a month, because all properties do is continue to go up in value, right? I mean, you can look at just historically, and let's take the United States out of the picture. Texas specifically has fared every recession extremely well as a state by itself. So with all those things in mind, and homes constantly going up in value, your best time to buy is always right now. It's not tomorrow, it's today, because it's always going to go up by 3 to 5% year over year. So if you're waiting 5 years to buy because you think you're going to time the market, you're wrong. So stop worrying about interest rate, worry about your property taxes. That's really what you need to worry about.
Yeah,
because Melissa may not have fought her property taxes ever in the entire time she's owned the house. She may never have filed a homestead exemption. And well, Stephen, her next door neighbor who lives in the same size house, he fought his every year. He did what he was supposed to do. And he's paying $5,000 a year. And Melissa's paying $10,000 a year because the county kept eking it up on her. That should be your focus.
Yeah.
Is my property taxes, because in Texas, they're getting brutal, family.
Yeah.
All right. Interest rate, you can change. You can refinance. You can do all kinds of different things, right? You can get a lower insurance rate. You can do, but the property taxes, good luck. Yeah. Good luck getting them to lower it from where you're at right now, because it's not happening.
Yeah.
So I get people to focus on property taxes for this kind of stuff when they're talking about this. It really, property taxes is the main thing, right? Yeah. Two houses, same street, same square footage, different property taxes.
That's true.
Yeah, I agree. And I do fight mine, just saying, and I do have my homestead exemption, and yeah, it's still high. Still high.
Clear your name, Melissa. You gotta let them know.
Yeah, our property tax has gone up quite a bit every year. So, and fortunately, you try to fight them now, and I mean, you can protest them, and that's why they call it protest. Good luck.
My kids used to protest too. They'd stomp their feet. And they didn't get what they wanted either.
They didn't say it was valid. It was just a protest. So just okay, whatever.
I tell my clients all the time. I'm like, you know what? This is the best advice I'll ever give you. It's not anything to do with loans. It's never upkeep the front of your house. Never. Don't take care of the fence. Do nothing. So when the county people drive by, they're like, God, what a dump. This is worth less. But this isn't going up as much as the other properties. Works every time for me. Works every time. You've been to my house, Melissa. I intentionally do not take care of anything visible from the street.
So you're saying your backyard is amazing, Ian? Is that what it is?
Well,
they do have drones.
Not the fence.
Oh, no, not the front.
If
That's what I'm saying.
See a nice fence, I'm hosed, right?
Yeah. I was just thinking,
oh, he's got money.
Your backyard must be beautiful because the front yard wasn't even there.
Exactly. And that's been my trick for 1,000 years.
There you go.
Every house, I mean, I'd have no HOA, right? That's another big thing. Don't have an HOA. you can really pull off some stuff. You can't do cars in the front yard. Plano does not allow that.
Yeah.
But yeah, I mean,
Call that yard art.
What's that?
You call that yard art, man.
Yeah, yard art. Exactly.
See what I'm saying?
It looks like a Chevy.
Yeah, exactly right. Hook a hose up to it. It's a fountain.
But yeah, no, it's tangent, delicious.
And Ian, you've been doing that 1,000 years, and I'm just saying you're looking really good for your age.
Yeah, there's just only a few grays in here, nothing to it,
For 1,000 years old.
Yes,
and you go paying a mortgage payment after 1,000 years. That's the scary part of the whole thing.
I just keep refinancing, keep pulling my equity out.
When are we ever gonna pay this off?
Cash out refi, baby. Well, all right. So let me go a different direction. So we talked all kinds of stuff about mortgages and taxes and all the things, but we know that some sellers are maybe a little fearful. We talked about how they might decide that after all that they do want to sell. Who is our upcoming buyer group? Like who's the next big wave of home buyers? What are we going to do to help those folks see that they can buy a house right now, that they can buy a house no matter, what the rates are doing or whatever, that they have options. What do you guys think? Who's the upcoming home buyer generation?
I'm hearing millennials.
Huh?
Millennials is what I'm hearing.
Millennials is what you're hearing. Okay.
Yeah. Millennials, absolutely. Gen Zers, absolutely. A lot of them made big job moves during the pandemic, right? And when I say big job moves, they moved where there was more money. So they've gone from making less to now making more than they had previously. And they're the upcoming market. They're late to bloom to it. I'm a millennial, right? Only reason I was able to buy a house when I did was I used my 401k, took out that hardship withdrawal, not a big deal, and bought my first house. And now that they're getting these bigger paychecks, they're setting aside money, they're doing all kinds of different things because they want to buy homes. It's not that millennials don't want to buy homes. It's that for so long, they legitimately could not afford it. And now they moved on in jobs.
I think minimum wage and stuff has gone up a little bit too.
Yeah. And so I think that's our next massive wave are the millennials and Gen Zers. We're going to start seeing them quite a bit more. You're still going to have your step up buyers, owned for, several decades, but that's the target market. And being able to tap into them right now is going to be your bread and butter. And also people relocating. The relocation that's going to be it, because a lot of people are going to sit on their low rates for a while, right? That's going to happen. And locally, you're going to have a lot of millennials coming up to buy, but you also have everybody moving here. So you catching those reload buyers is a massive, massive deal.
Yeah.
We got a lot of people moving to Dallas-Fort Worth.
Yeah. They did a thing in January where they were talking about the number of people moving to Texas every year. And I can't remember the number, but it was staggering. And then they said, and then this is how many of those people were moving to the DFW. And that was also a ginormous number. Yep. And then they said, and if you took all of DFW, this is the number that are moving just to Collin County, which of course is where Plano is, where Ian lives. And man, ridiculous amounts of people moving to Texas, moving to Dallas, Fort Worth. And then of those groups, the migration to Collin County was just it was a lot of people.
Well, the Dallas and Fort Worth area is going to, I think, surpass Austin.
Oh, yeah, I'm sure.
I remember how the big wave was going to Austin, and everybody's like, oh, we're going to Austin. Now I think it's going to be moving more towards north. Yeah. I think a lot of IT jobs are up here, millennials like IT jobs, they're more, there's just a lot more opportunity in these areas.
Yeah, for sure. So we're capturing the relocation people that are moving here. We're capturing the younger generation who's maybe just late blooming, but finally getting into this, I'm going to buy a house. Maybe they saved some money. Maybe they were living with family. I feel like for a while, there was a time when everybody was like, they're all moving back home. And they were giving a lot of flack to the younger generation about moving back in with their parents. But that might've just been the smartest thing they ever did if they were able to save some cash and now go out and become a homeowner.
I've seen a lot of parents now give early inheritances. They want to give it to them now that they're alive instead of enjoying it now, instead of having to dish it out later. And also, tax benefits too. If you start dishing it out now, it might be a lot more easier to swallow if they got it in pieces now than it would probably be in a lump chunk. So I've seen a lot of that too. I've dealt with a couple of people that say, hey, yeah, my parents are going to give me a down payment on a house, and they just call it an early inheritance. That makes sense.
Yeah, I actually had somebody that did that right at the tail end of the year last year, and their parents just bought them a house.
Yeah.
Just paid cash, and they're like, here's your early inheritance. I was like, dang.
Yeah.
Wow.
Where was this when I was buying a house?
Right.
And are they adopting? That's all.
Yeah, well, and meanwhile, I'm thinking, what are my kids going to expect?
Got rid of them. How about me? I look for adoptions. So yeah, it's a changing world. And I think also a lot of the parents are understanding it's harder for these younger generations to come up with that down payment money when you got a $600,000 house, or in our area. I mean, I'm in the Roanoke area, Alliance Corridor area. That you can't even find a house for less than $500,000. That's a house about that big. And good luck to you. And you're renting a 1-bedroom apartment for $2,000 a month. That's a lot of money. So even though you're making more, it's kind of hard to sock it away too.
Yeah.
And I think now parents are starting to go, or grandparents or whoever it is, they're going, hey, wait a minute here. If all we got to do is give them $50,000, get them into a house, and get them out of that rental situation, that makes perfect sense.
Yeah, because they could afford the house payment, right?
Yeah, absolutely. They've proven that they can
figure
afford
out
a house payment. You could live in a $2,500 a month apartment. You could afford a house payment. I mean, another thing too is a lot of people are starting to not want to go to college too.
Yep.
I've seen more kids now. Kids meaning, I say kids because they're younger than me, but 20s and 30s now are going, I don't want to go to college because what's it doing? I mean, I'm not knocking education by no means. I have a little bit myself, but I mean, the thing of it is could you have done the same thing without it? If you look back on it, I got a lot of people out there that come out of school with a business degree. Everybody's got a business degree. We all know that. That's a basic standard degrees, apparently. And so they're coming out making $40,000, $50,000 a year or whatever. And you got somebody driving a tractor making the same amount of money, working 9 to 5 instead of working at a business, working 90 hours a week. What makes sense? So sometimes, how about start your own business?
Yeah.
You don't need a business degree to start your own business. And so I think people are starting to realize that there's more opportunity through trades.
Yeah.
Possible, working hard and maybe working your way up seems to make more sense. And it's just a better opportunity all the way around. And parents are going, hey, we would have spent $100,000 a year on you in college. Why don't we just give you $100,000 and go?
Right.
I mean?
Well, yeah, because the debt for college is expensive, and that can really screw you up buying a house too.
I'll tell you what, and it just makes sense.
Yeah.
Yeah, I mean, speaking on the debt screwing you up for college bit, man. I mean, they had to create special loan programs for doctors to be able to buy houses.
They're coming out of college with $400,000 worth of debt.
Yeah, because their debt load is so massive, right? And they know the servicing is going to be massive too. So they created special programs where doctors can even do 0% down. I don't have a lender, I don't have an investor doing those right now, but I know of other companies that have that because their debt load is so crazy. They know, well, this guy's never gonna be able to save up, but he can still buy a house.
Yeah. Well, yeah. I mean, the income potential is so great to get all that debt paid off at some point, but yeah, it's like a whole process. You don't pay off that kind of debt like overnight. You just don't.
That part is not as great as it used to be.
Yeah.
Yeah. You just die with the debt, just die with it.
That's it right there. They never
keep pushing it off, never pay it and die with it.
Pay him $1 a week. I mean, this guy's been paying a mortgage payment for 1,000 years. I mean, let's think about it.
That's true. Yeah. That's true. And you've been paying a mortgage payment for 1,000 years.
I got into mortgage because I got locked into a 1,000-year loan.
Hey, this house has only gone up $140,000 over 1,000 years. That's the most incredible thing I've heard in my life.
That's it. That's it.
You must run that thing down. My
God. Oh my God.
Yeah, no, it's true. I mean, a lot of millennials don't even know that they can buy houses even having their debt, right? Because what no one's explained to them is they're not making payments on it, right? And so they think, oh, you know what? They're going to see all this debt. They're just not going to let me. But the thing of it is that payment, you can create a fictional payment one of two ways. on college debt. First way is you can use 0.5% with Freddie Mac. If you're going to do a Freddie Mac loan, you can do 0.5% on the total debt that they owe, because most people are not making payments right now. So let's say that somebody's got 10,000 in student loans. The fictional payment that we create is $50 a month, right? That's just like having a credit card with a minimum payment every month. It's pretty cheap on the DTI side. And when you look at it and you say, oh yeah, it's $50, but if they called up that company that's holding that debt and they're like, hey, I want an IBR or income-based repayment, that $50 might turn into $20, and they're not obligated to start paying it yet because it's still postponed, but it gives us another number that we can submit with the loan that says, hey, that's not actually $50. That they said they'll do it for $20 when the time comes because of their income-based repayment. So millennials are worried, they're saddled with so much debt with their college and everything else that, oh, I can't do it because I have, 80 grand. Well, turns out you can, because there's multiple ways to skin a cat. And in this case, we'll look at it and see which one provides us with the lowest number and use that one.
Yeah. Well, it kind of goes back to what we said in the beginning when I was talking about if I wanted to rent my first house and buy another one. And I asked that question, are you going to look at like the fact that I have $400,000 in debt on this other house? Or are you going to look at the fact that I have like a $2,000 a month payment? Right?
Yeah, we're going to look at the payment. Yep, absolutely. Yeah. Every time we look at payment,
it's going to be the payment. So if I have $80,000 in student debt, all you're really looking at is the $50 payment, not the $80,000. And I think that that's a really key point just all the way around, is we're not looking at the total, oh my gosh, you owe $9 bajillion. We're looking at what is it, can you afford to make the dang payment every month?
The month.
Right, because we don't want to put you in a house you can't afford, right? Because then you're just going to get foreclosed. And Ian, do you want the house back? No. You don't want the house back. You want them to live there and love it and grow old there.
Well, there's good news. The student loans might be taken out.
That's true too.
They might be extinguished.
That's a whole topic of discussion. That's for sure.
So that's going to open up a lot more buying power if it does.
Mm-hmm.
That spurred a lot of conversations with a lot of people calling me about it. Like, hey, I think I'm eligible for the program to be able to get my student loans extinguished. Hey, how does that look for me? I'm like, well, I mean, you only have $9 grand. So like, really to me, that translates to like $40 a month. So they're like, what? I'm like, yeah, you could have bought a house, or you can buy a house. And I mean, it got people thinking, like, student loan debt, albeit, yes, it's a lot of debt. It is what it is, but it can still work to buy a house. You don't have to let that be what stops you from purchasing a home.
Yeah.
Because in your mind, you've made it up to where you think that that's what the problem is. I have $100,000 in student loan debt. There's no way I can buy a house because I have too much debt.
Yeah. And that's just flat out false.
Well, that's a rumor. That's again, false information.
Yeah. Yeah. That's people either not checking, or again, you check in the wrong spot.
They probably asked their friend.
Listening to the news or Google or whatever, like Stephen said in the beginning, you might not be getting the right information. Call the professionals, call the folks on this call for sure.
I love it when they call their friend. Yeah, my friend told me.
Mm.
House? No, he's in worse shape than you, but you're asking him for advice. Perfect.
Yeah.
Perfect. I like that idea. And they live in Alaska. Even better. We're in Texas. So see, I mean, it's other ways of doing things, So that's why I always tell people, hey, find a good resource, find good advice, find the people that can give you that advice, and stick to them.
Yeah.
If you start veering, it's over.
That's right.
That's a rabbit hole.
All right. Well, speaking of good advice, so Ian, you've given us a lot of good advice today. Thanks for being a guest on the show. Is there anything else that you feel like we need to cover, we didn't cover, that you're like, oh my gosh, burning question or concern or thing that just needs to come up? Good topic.
I mean, I think that, and this is just my personal opinion, this kind of just has everything to do with building your business, your brand, your everything, right? And this is something that I know Melissa does extremely well with her team. And Stephen, I've just met you, and I guarantee you probably do all this stuff well too. But if you're wanting to capture this new generation of buyers, the best place to be is on all the apps that they're using. I'm closing a transaction tomorrow. This girl has 250,000 followers on TikTok. Okay.
Wow.
She's a millennial, but she found her home inspector through TikTok. So the home inspector that went out to her property was the one she had seen 1,000 times on TikTok, showing off the horror stories of things that the inspector finds. And I think that if you are a lender, an inspector, a real estate agent, anybody in a world providing a service, if you're not using all of those things, you're not going to be able to capture this generation, or you'll do it so late and someone else will have already capitalized on it. We're in a lull right now where we can really build that market share, but you should be doing these things to capture this upcoming buyers market, or upcoming buyers period. Yeah. And if you're not, you're gonna be dying.
Yeah.
I know how to transition.
Yeah.
Mm-hmm. Yeah. Man, and Ian kills it. Ian is all over every reel I ever see. I'm scrolling, I'm zombie scrolling. That's what I found that the term is. You get your phone and you're just like not really paying any attention. You're zombie scrolling, and there is Ian's little face all the time on all the channels.
I have made $4.06 off of my Facebook Reels. That's all I'm saying. I think I'm leaving lending and I'm going straight into influencer, and that's it.
That is absolutely amazing.
I know.
No,
please hold the applause.
Yes. Well, you are, according to your thing there, the second best lender in DFW.
Well, everybody else is the first best, so there has to be a second, and no one's going to contest this.
I like that. That's good. That's good. So.
It is good. So yeah, I agree. I think social media and being just anywhere where they are, right? And that's the case. It doesn't matter what generation you're trying to reach. It doesn't matter. You got to go where the people are.
Yeah.
And sometimes the people are on a device, right? Like that's a true statement. Sometimes they're just on their device. Sometimes the people are out and you got to go. And man, the more people you know, the more business you're going to do, period. Whether you know them, because you can shake their hand and you can be like, hey, I know Stephen, he's in my phone. Or whether you know them because you saw them on TikTok 4,000 times. Because you said, Ian, a minute ago, you said, I have this friend. And then you were like, actually, it's just somebody who follows me on Facebook. It's the same thing, right? Like, is it your friend or is it not your friend? You don't really know them, but you know them. Or they know you.
Yeah, absolutely. And that gives you like an immediate icebreaker because your rapport is already built. It's building for you while you sleep. Right. So when somebody calls you and they talk to you and you're the exact same as you were on your video or wherever you were, there's a level of comfortability and loyalty to you and what you're doing. And a lot of people think that, doing all these things is crazy. But I mean, tell that to my messages inbox with people who are hitting me up about getting loans. Right.
Yeah.
I don't have millions upon millions of views, but that's not what it takes. It's not about view count. It's about the quality of the view, right? Yeah. 1,600 views to people who are looking for those things or are down that rabbit hole of buying a house, and they see your mug up there and you sign off and you say, my name's Ian and I'm a lender in Texas. If you need anything, I'm always available. It works.
Yep. I've heard you say that a whole bunch of times as I zombie scrolled. Just saying.
Just saying, you're welcome. That's it.
It's a subliminal role now, or reel. Is that what they call it? Reel? Reel or whatever they call it.
Yep, reels, the TikTok, the Facebook, whatever. They're all, yeah, man. Yeah, get out there and build your business. I think it's important for sure. And the buyers are there. And now we have the programs that are there. So when you do find somebody, you know what you can talk to them about because you got educated because you came in, sat in and listened to this podcast. So good stuff. All right. Anything else y'all need to cover? Because otherwise I'm going to get us out of here. Nope.
I'm good, Melissa Haley. As long as you're good. That's all that matters to me.
I'm doing the happy dance. I'm good.
Oh, there it is. There we go. There, don't hurt yourself.
There you go. Oh, yeah. I am not a millennial. I'm like
break a hip. Up there with.
True statement. Oh my gosh. All right. Well, y'all, thanks so much for being here today. I super appreciate it. Stephen and I appreciate you joining us, Ian. And everybody out there, y'all join us next time on the Estate of Reality podcast, where we're going to keep talking about all the real reality of the real estate profession. We'll see y'all next time.
Have a good one.